Michael Perenich, I have a question.
Yeah, sure. Go ahead.
Who made more money? Tesla going from $50 to $800, or Raymond James stock going from $2 to $125?
It's a trick question.
Trick question. We're talking about factoring in splits.
No, that's just nothing. That's just run.
JP hates Tesla because I won't let him. I won't drop it. Yeah, I lost like thousands of dollars.
Okay, so
I think Raymond James stock there, obviously.
Yeah, well, there's a little time difference. Raymond James took 35 years to do that, and Tesla did it in 18 months.
Well, imagine if Raymond James had Elon Musk at the helm.
Then it wouldn't be called Raymond James, you idiot.
Raymond Musk.
Raymond's Musk.
Raymond James had a 62-fold increase, and Tesla had a 16-fold increase.
So far, give them 35 years and they'll be bankrupt.
Yeah.
Okay, so we got a hard stop at 6:45 because that's what I told myself. So let's get this party started. Perenich,
all right.
what the hell are we doing? What is this?
I'm sorry, what? Oh, welcome to Stonk Tonk.
Cool.
Yeah.
Hey, I'm the guy that goes for Stonk
Welcome to Stonk Tonk.
The greatest resource of stonk news on the internet.
Coming to you live from KCCBS, Stonk Tonk. Well, welcome to Stonk Tonk.
We're going to talk about stonk.
Welcome to Stonk Tonk, guys.
Stonk Tonk. Stonk Tonk over each other.
Oh, we will. Don't you worry.
Excellent.
So, John, are you investing in some stocks currently?
Lots of stocks, yes.
To tell me what you like and what you don't like, and who's your dad?
Who's your daddy and what does he do? Well, what am I looking into? I mean, right now I'm just kind of focusing on ETFs until I can drink Old Forester, because that's my end game there. But I'm just trying to figure out how to fucking invest. There's so much convoluted bullshit out there. So I'm just trying to understand different strategies, understand if dollar cost averaging's worth it, or if
what do you feel like your hurdles are to like just getting into the market more?
Just education. I mean, there's tons of really good strategies out there and tons of good ideas, but I want to make sure I'm making the right one. And so I don't know what the hell that is, how to do that, or just like if you go on Wall Street Bets or any other subreddit and you're like, hey, what do you guys think of this stock? They're like, do your due diligence. And I'm like, how? How do I do my due diligence? I would like to know.
My wife's name is not Diligence.
It's due.
It's due diligence.
Yeah.
So I think that's true. However, got news for you. No one knows what they're doing, and they're all guessing.
I disagree a lot on that.
So look, there are certain things that obviously are more speculative, and there's some things that are safer, right? You're talking about ETFs. That's seems like a safer play, right? Because you are spreading risk, right? But then you also don't get as much reward as fast, right? So you could invest in SPY, you could invest in the S&P index, but like, you know, sometimes the S&M index where you get spanked, and if you progress far enough, you get spanked like 30 times a day. So I think that there's a lot of excitement in a stock that goes from like $6 to 60 or like 300 or whatever. So I think that like a lot of that is, you know, someone might tell you, hey, have you looked into uranium? Like literally a buddy asked me that yesterday, and I was like, uranium? What for? He's like, what's that?
Weapons grade?
No, just yellow cake.
Obviously. Don't touch that yellow cake. John Paul, have you heard about this investment into uranium?
Yeah. It reminds me of, you know, the difference between, you know, Captain Kirk and toilet paper. They both go to Uranus to wipe out Klingons.
Wildly relevant.
Yeah.
And just so no one's listening to get some real input from us, we don't know what the hell we're talking about. Any financial advice?
We are not financial advisors in any way, shape, or form. Please do not take our advice literally.
That's
On the subject of uranium, Bill Gates has developed a sodium-cooled nuclear reactor which runs off of spent fuel rods from existing nuclear power plants. So the demand for uranium going forward is probably not going to be that good. Seeing as how the technology works, and the Chinese ordered 20 of these nuclear plants, but of course Donald Trump put the kibosh on it, but now the orders are coming back in.
So there's speculation about like the future as far as like fusion is concerned, and so the uranium play would be like a long-term play, but obviously if fusion became a reality, you don't need as much uranium as you would to run a regular nuclear power plant.
You don't need any uranium for fusion. Like fusion operates seawater.
That's what he's saying, Dad.
Yeah, so it's anyway, so that's one play that I found interesting, but it's like really long-term, a bit speculative. And there's an ETF, or I think it's an ETF, it's quadruple U. And I thought I put a few bucks in it because I thought, well, I don't want to be short-sighted. So it's called Energy Fuels.
But how reliable are commodities? I mean, they just kind of seem very volatile. Like you never really know what the hell's going to go on. Like, look at silver, look at gold. Like that shit is spiking and dropping constantly, and you have no fucking idea. Like silver traders themselves are like, yeah, I totally bought in at like 97 cents and got 98 cents 4 hours later. It's insane. I mean, like there's so much more that goes into that than just like a business.
Well, I don't know where.
Right. I mean, and go ahead.
Why did you think uranium would be a play? I mean,
so the question about uranium was basically a conversation I was having with a friend, and he was talking to me about just like some other stocks, like because we were talking about these companies that are mining Bitcoin and how a lot of these things that I've invested in early on have paid dividends, like not literal dividends, but they've panned out. And he's looking at like future commodities like uranium. And I said, uranium, you know, what's up with that? And he said, well, there was I want to say it was like France, but there was a nuclear power plant popping up in Europe, which are going to run a lot of Europe. And so uranium is going to become a hotter commodity as some countries turn toward using it nuclear as their main source of electricity, obviously, like aside from renewables. So
where'd you run, Jeff?
Yes, like Iran.
Well, you know, kind of the opposite. is happening is, from what I've heard, that Germany is shutting down their nuclear plants because they don't want the risk. Now, France has a lot of nuclear plants, but the general trend is a downtrend on traditional nuclear plants globally since Fukushima and all these other problematic places. So I would be shorting uranium if you wanted to speculate in it.
So,
hey guys, let's John. Yes, John, you have a question.
yes. So, Bob, where do you do this research? How do you get this information?
Good question, John.
About Germany?
No, just your general research. Like, you obviously know a decent amount about what's going on with this commodity uranium. You've kind of read some articles or something. What do you?
No,
how do you do that?
I read CNBC every morning.
But they don't like GameStop, so I can't read them.
No, they do. They talk about GameStop when it's a big enough news event to be there. So I mean, it's a sensationalistic news outlet, but it gives you all the nuggets.
Yeah.
But it doesn't deep dive. I mean, the most credible source for that kind of stuff might be The Economist magazine.
Well, we only want what you read. We don't like, because you are very successful. Let's take a step back and introduce everyone.
Hey, there we go.
Perenich is fucking dive bomb with some uranium, which I like. But yeah, all right, so Perenich, you and me started the show last week, and it has just set the world on fire. Everyone's talking about Stonk Tonk.
Yeah.
Everyone's talking about it.
Yeah. And this week we have two very special guests. How do we know each other? I'll let them explain. John, why don't we start with you? Who are you? What do you do?
Well, I've known you for quite a few years here, Chris,
Yeah.
and Mike, just a slightly less. Main route I know, Chris, is that you terrorized me for the first 30 years of my life, but
just the first
but hey,
30?
oh wait, no, I'm actually 30. I don't know how old I am now. Last year was a millennia.
John, yesterday was your birthday.
Again? Shit.
Did you forget your birthday again?
And both of us were lucky enough to come out of the loins of the guy below me.
Below him. Yeah. And then we have my cool dad, Bob Brodhead. So that last guy was my brother, and this guy is my dad. And Perenich is my brother, also my brother, but not by blood.
Mothers.
Yes.
Different mothers.
Brothers from different mothers.
Yeah.
Same.
So one of the reasons we invited you on this show. So me and Mike talk about Stonks that we're really excited about, and so we just wanted to hear what Stonks you guys are excited about and why, and then maybe some general investing knowledge. So we'll start with Wanoban with John. John, what Stonks have got your circles talking these days?
I mean, recently I've just been kind of my whole start in investing a few weeks ago. Ran across a few YouTube videos on like dividend investing. So I did way too much research into that, only to realize I don't think it's the best strategy for me at this time.
What?
But because the dividend investing is it's a good idea. Like it'll make you some decent money, but the returns on it aren't nearly as good as just literally investing in the S&P 500 or just trying to find growth stocks. And then once you get to a certain age, then I could transfer those holdings to dividend stocks so that I can basically live forever. Just because they'll pay me $80,000 a year or more just by holding the stocks. I don't have to sell anything. But
yeah.
In doing so, I have come across a few really interesting companies. AbbVie, they are a medical pharmaceutical company. They are a large dividend holding I have right now, and they just do a lot of stuff. They do a lot of like cosmetic drugs and things like that, as well as some
Cosmetic drugs?
like Botox. They owned Botox.
Mike gets a lot of
And
that.
yes.
How do you think they look this pretty?
Right. So yeah, they just seem like a really solid company. They've been paying dividends for over 10 years now, and they just seem to be in the right place at the right time and doing a lot of really good investments. Outside of that, I've really been looking into Disney, just because
Oh,
yeah,
John,
they did
what's up
recently.
there? I believe it's Disney. That's actually a G. at the
Right,
front.
it is a G. That's
Yeah.
Disney.
Some people say Disney. I'm a old soul. I say.
Yeah, no, Disney is just massive, and they're just killing it in everything they do. Their leadership is just absolutely crushing it. Them getting into the actual like kind of Netflix like subscription services with the amount of content that they just own is just a no-brainer. And that they were able to do that during the pandemic and continue to absolutely crush the market. Once they actually get their parks open, it's just going to be hand over fist them making money. So just a really, really good opportunity I see
John,
just going forward.
what got you into dividends in the first place?
Well, I was really bored at work and had a lot of time on my hands, and I randomly just came across some Reddit posts of like, you should look into dividend stocks. I'm like, all right. So I found this
Sounds
one.
good to me.
Yeah,
I've
basically.
already exhausted my Pornhub account. Might as well.
I know. Well, I have carpal tunnel on my right hand, so working on my left. But
my left hand's got 90% carpal tunnel.
But no, and then
After
I came
watching
across
every video on Pornhub.
yes, all 4 million of them.
Now his ankles are going out.
But
Real tough,
no,
tough
I came across a few YouTube channels and just really liked what they were doing. It just made a lot of sense.
Which ones? What channels do you recall that you enjoyed?
Joseph Carlson.
specifically on Pornhub.
Yes.
Yes.
Specifically, Joseph Carlson, and that eventually led me to this other one that I'm actually really, really liking right now. It's called Learn to Invest. It's just this guy, Jimmy, from New Jersey, but this fucker is awesome. Like he explains everything about the stock market, like how to research it, how like the formulas work, like literally like grad school level courses for free on YouTube. And so I've just been trying to.
And what's his name?
His name is Jimmy, but his channel is Learn to Invest. I don't remember his last name.
Okay.
Yeah, so I've watched a handful of his videos, and like he's also doing some dividend stuff, but he's also just talks to you like, hey, here's how to actually research a company. This is what you do. You look for their 10Q, their 10K, read their business plan, understand what their competition is, because it actually explains it in that document. And then let's look at the finances. What's their income? What's their free cash flow? How much debt do they have?
Where do you find all this info, Richard?
That document, the 10K document. So if you literally type in Disney 10K, you can pull up. It's the 10K is the annual document for their company. It's like, hey, we are a publicly traded company. This is our mission statement. This is what we've done the last year. This is everything we're trying to do. This is our competition. This is everything about our business and why you should invest in us. So it's almost somewhat advertising. And it's great because it breaks it all down for you. You can see who the competitors are. You can then do the same investigation on them and see if you like them better or not.
I would like to admit
What's
to
JP
something.
saying?
Oh, sorry. Was JP saying?
I was just saying that that's pretty good. And I think that Disney is solid. And besides the 10K, you get the most real information from the quarterly reports in which the research analysts are invited and they ask questions. And the questions that the research analyst asks of the CEOs reveals the closest thing to truth about what's going on. So the companies that make the most money are the companies that have a monopolistic position. Those are companies that it's hard to break in to their business model.
Facebook, Google.
You want to
Pornhub.
in those, there's an ETF called MOAT, M-O-A-T, which implies the water ditch around a medieval castle that prevents anybody from getting in the castle. And so what MOAT holds are the companies who are making profits which with the highest degree of invincibility or competition is too hard to get at. So that's kind of, now if you opened up MOAT, if you went to CNBC and typed in MOAT and then scrolled down to where it said profile and you punch that button, it will open up the portfolio and show you those stocks which are inside the portfolio. And I think it has about 30 to 50 companies which qualify as MOAT stocks. So those tend to have the most consistent growth rates, but they might not be as profitable as saying getting lucky by buying Apple when it was 30 or Tesla when it was 200.
Well, I mean, specifically with that, it's just like, yeah, sure, they may be monopolies, but the thing is, like, if they're a monopoly, what's their point of growing? Like, they already own everything. So that's just one thing I can argue against that.
Yeah, monopolies, tend to have consistent profitability because of the lack of competition. And, sometimes monopolies are created through political contribution, where a company bribes Congress to give their industry or their company a particular advantage over the others. Like, for instance, when George Bush made it mandatory for every retired person in America to get Part D of Medicare, that meant that they had to pay $30 or more a month to the pharmaceutical companies. So they were locked into buying drugs. The other thing that he did, he passed a law that said that Medicare had to pay full retail to all pharmaceutical companies for the drugs that were used for all retired people.
Oh, shit.
So the whole pharma industry gained a kind of monopoly, which was purchased by bribes to Congress, which they call it PAC money.
Or lobbying.
Really, yeah, lobbying. There's really bribery.
I mean, that's lobbying is different than PAC money. But yeah.
Same intent.
Well, I mean, yeah. I mean, it's, hey, I got some money. I'm going to give it to you to help you out so it's easier to get elected somehow or another, right?
But that's for our political show.
Right.
Let's
The lobbyists.
Yeah.
So, Dad, you are a very successful young man.
Would you say that? I mean, I don't know.
Dad, you were able to retire at 55 so that you can just make paddle boards and watch UFO documentaries, and and you're my hero. So how did you do that? How are you able to invest and just kind of like keep everything good so that you're like, I'm 55, like nuts to this, like peace out, corporate fuckers.
Well,
did you do that?
Well, early on in my career, I discovered that the only part of the stock market that you could really count on were portfolios of dividend-paying stocks, and the reason was that normal growth stocks, or stocks without dividends, the volatility, the ups and the downs were so great that the participants would be scared out of them when they went down, and so they'd go down a lot further. So there was a lot of volatility. Now in a dividend stock, if you're making 2 or 3 or 4%, and you're getting that all the time, that doesn't change if the stock goes higher or lower. So when stock went down, the dividend gave it a buoyancy. So fewer people would jump out of it during a down period. And so the stock would continue its upward momentum at a steadier pace. And so if you looked at all the mutual funds from 1980 until 2000, it was the plain Jane dividend stock portfolios that would win the race. But they wouldn't be flashy, and they wouldn't be the fastest, and they wouldn't be the greatest, and they wouldn't be this and that, but they were the tortoise that got to the finish line. But a large part of my success was when you're younger and you're trying to build assets, you put a bulk of your money in these dividend stocks for your consistent runner, and then you have to gamble, and you have to put a lot of money in one thing or 2 or 3 things that you really think are going to run. And for me, it was this silly little company that I joined in 1985, whose stock was $10. And it was Raymond James, and they only had 300 stockbrokers. And when I retired in 2005, they had 6,500 stockbrokers. And the stock had gone up 500 times.
Holy shit.
Did they pay in stock?
Yeah, they gave me stock and I bought stock. We could buy it at 85 cents on the dollar. And they gave.
Wow.
And so it just grew bigger and bigger and bigger and bigger and bigger. And I knew by being inside the company that they were doing good things, right things. They were long-term investing, not short-term. And I knew this thing had longevity. It wasn't the fly-by-night. It was gonna succeed. And everybody thought, well, it's kind of a laggard. It's kind of slow, but the thing just kept going up and up. It actually went up 20% a year for 15 years in a row.
Oh,
wow.
So that's a huge compounding rate, because if you make 20%, you double every 3.5 years.
that's
Wow.
double the 72 months.
Yeah,
That's
it's really
double your.
yeah. So 20 goes into 72 3.5 times. So every 3.5 years, my money was doubling.
Thank you.
So that's just 20%. So
So do you still recommend your strategy of the dividend paying ETFs?
oh yeah, but that's like a core holding. You would put like half of your money in those kind of things, and then you'd put the rest of your money in some higher growth, more speculative things that you'd have to watch, because you don't have to watch the dividend portfolios. You just buy them and never.
Here's my problem with those stocks, though, is like I own some Vanguard stocks. They have a high yield ETF.
VYM.
Yeah, VYM, and yes, and it's a great stock. Like it's even Friday, it's still made up on a shit market day, which is amazing. Yeah. But my only thing is it's not enough like gambling when I don't have to watch it.
I know. It's no fun. Now the other thing is, if you look at it on the chart is understating how much it's growing because it spits off a 4% dividend.
Yeah, that's
They're
true.
not reinvest the dividend
because they're paying it out. So as soon as they pay it out, that stock drops that much.
And it goes into your money market. Say, so it doesn't show a true reflection of how much growth there really is. So if it goes up 8% in a year, it's really gone up 12%.
Yeah.
So when you look at the chart, it's underwhelming. But if you add in the 4%, then it's doing better. Now, right now, if you want to invest and make money, you want to look at banks and brokerage firms. And the reason is banks make their biggest money when interest rates go higher. That's because their spread or their margin between what their cost of capital is and how much they make when they loan it out gets exponentially bigger as interest rates get higher. Say
So like a JP Morgan.
Yes, a JP Morgan, a Bank of America, a Raymond James, a Schwab, any of these companies that managing big pools of money are going to make a shitload in 2 years from now. Say when interest rates have to go higher because of all the deficit spending. Say, but you have to buy it this year to be a year ahead of the cycle or 2 years ahead of the cycle.
Wait, so you think interest rates are going to go up soon? Is that what you're saying?
Not soon.
Yeah.
In a year, year and a half, 2 years.
Why?
Well, because of the $2 trillion thing we just did. Because of the
COVID relief.
Yeah, all of the money borrowed to pay for the COVID issue is going to come back in 2 or 3 years and become something that's going to drag interest rates higher, and the banks are going to make a fortune, and the brokerage firms are going to make a fortune.
Okay,
so,
I'm going to ask this question for people that don't understand interest rates. Obviously, I understand them. For the people that don't understand interest rates, what the hell does that mean exactly, Bob?
yes. Well, okay, right now, the 10-year Treasury, it pays, if you put your money away for 10 years with the federal government in a 10-year Treasury, they're going to guarantee you all your money back plus 2%. Okay. Now, historically, that 10-year Treasury pays between 6 and 8%. Say, so it's extremely low right now. And a few months ago, it was at 1.5. You know, is even at 1%, like 6 months ago, a year ago. So it's climbing a little bit, but that has compressed the profitability of the banks. Even though the banks have made some money, they'll make more money as that rate starts to go higher. So when the 10-year Treasury goes to 3%, then 4%, then 5%, the banks are going to make a lot of money. Mm-hmm. So that's a speculative. And because the stock market is an auction market with everybody anticipating what's going to happen in the future, you have to buy a year in advance of what might happen. You have to get ahead of the crowd.
One of the things
one of the things is interest rate can't go lower. Though, like it's almost at zero. So you have to see like that as well. Like, hey, it's going to go up.
Yeah, like
eventually.
The rates are negative.
Holy shit.
And in England, I think they have a couple of rates that are negative.
Take your money for
you have to pay money to keep your money in their bank.
Dad, how do you, okay, so, you know, you're trying to get ahead of the market, and is this just your own kind of speculation? Like, okay, we just passed like close to $6 trillion in COVID relief. Like, obviously rates are going to go up, banks make money when rates go up. Is that just your own kind of experience, or do you?
Well, no, I mean, I read, but like if you were to read CNBC, just one page, this is the front page, just blurbs of it every day, you would start to get the feel for what these analysts are saying. Now, half of the analysts are touting something because they have a position in it and they want to trick fuck you into.
That's why I hate CNBC.
Yeah.
For many reasons, but that's probably the main one.
Yeah. Yeah, so you have to know that that's happening in some cases, but you will start to see a consensus amongst people, about what the future's bringing. And if you have a Schwab account, they have a very good technical research analyst there that you can read, and Raymond James has a really good one that gives you kind of a feel for what's likely to occur going forward. But
What do you mean by that?
always right. So, I mean, another way to play it is to anytime the market goes down between 5 and 10%, you buy more. And anytime it goes up, you sell off a little bit for future trading. So you can kind of do this minor skimming off and buying more of the same old dumb shit that you always buy. You're just buying VYM. Like,
Yes, John, in the front row.
So,
Jonathan,
so Bob, I got a question for you. What's
You have
your
5 minutes left.
philosophy? Yes, what's your philosophy? Would you rather do a dollar cost averaging or do a lump sum investment?
and for the people that don't understand what you just said, please explain.
okay,
Well, all right, yeah. So let me give you a quick example. So, dollar cost averaging is, let's say I'm going to throw $100 a week into my brokerage account and just buy these holdings. So every week, no matter what, I'm going to spend $100, buy these holdings over and over. So I'm going to hit the lows, I'm going to hit the highs, I'm going to hit the mediums. I'm just going to constantly be buying, and because the market's growing, I'm going to eventually get a decent rate of return. If I do a lump sum, that means I have to do a lot more research. It means, hey, here is when I'm going to buy X stock at. Like, I've done my research. This is how I value it. I think that if Disney ever hits $100, I'm going to throw $10,000 into it right then, because I know that's the lowest it's going to be for a long time, and then it's going to exponentially grow. So, back to Bob, what is your philosophy on that? What would you think is the best?
Good question, John.
Okay, so both of those are good. And foundationally, the dollar cost averaging into a market like now, the market is really high.
Mm-hmm.
However, it might just get higher and higher and higher as this economy might fucking just take off like a rocket with all this money. So what John is doing with dollar cost averaging is really good. But what I like to add, put the icing on the cake, is your dollar cost averaging. But if the market does a 10% sell off, do a double, triple amount on that moment, and continue to dollar cost average. But if you get a 10% decline, buy twice as much as you normally buy, or 3 times as much as you normally buy.
Hey, Dan,
I did Friday.
So if you have $1,000 every month and you're going along, and 3 months into the year, the market goes down 10%, put in 3 months of money on every 10% dip.
Follow-up question.
Early.
Can I borrow $10,000?
Time for the next dip, John.
Damn
Go
it.
in your room.
Hey, TechStocks just crashed, man.
I'm going to give you $1 a day for 10,000 days.
Perfect. That's all I wanted.
It's going to be in pennies. You got to pick it up with your anus.
It's based on the Polish lottery.
All right, guys, we got 2 minutes left until we got to call it a day. This is awesome, Dad. Perenich,
this was a lot of fun.
You got any questions? I feel like I hogged the question.
No, I just want to give everyone a quick tip. If you guys want to make a lot of money, it's very simple. Look at whatever stocks I'm buying and then short those stocks, and you'll make tons of money.
He's not wrong.
That's brilliant.
The next time we do this, everybody come up with a single stock or something that they like, that they would consider putting their money into, and tell us why.
Ooh, yeah. I like that.
Pick a stock and tell us why.
And then talk about it.
Yeah, we'll talk about it.
Yeah.
That's cool. So, okay, final question, John Ball. So is CNBC just you go to the website and you just like read the homepage?
Yeah, you'll just scan the front page and there's like 20 articles and just pick out whatever topic jumps out at you. And over time, you will gain a very kind of broad sense of what's possible, what's coming, what sectors are hot, what are cold, what the rotation is happening, and that sort of thing.
Okay.
So,
and how do you tell who's pumping and dumping and who's preaching the truth?
Just dumping.
Usually are characterized by there's just one stock that they're talking about, you know. And those guys, I pay more attention to the generalists, the people that are telling you about market trends, about, you know, what's happening in the economy that's going to spill over into certain segments of the market, you know, and the things that a broader impact that are going to affect, you know, baskets of the economy and where going forward is going to be good. Like right now they're saying, you know, that technology will continue to do good, that discretionary, that healthcare, those kind of categories, and financials are the best. And the worst going forward is going to be electric utilities and communication utilities like AT&T and oil stocks.
Well, AT&T is trash. They bought DirecTV.
Yeah, they're stupid.
Yeah.
But it's a dividend-paying stock. Don't hate on
But
it.
honestly, I do still think Verizon's pretty decent just because they're pushing the 5G hard. But either way.
Yeah, and you got to be careful of super high dividends too. That's kind of a sucker play.
Anything over 5%, just be wary.
That's it. Yeah.
That's what she said.
That's what
Okay,
she said.
awesome. Well, we'll do this again, possibly next Sunday if everyone's available. And we'll each come with a stonk that we want to tonk about.
There you go.
All right.
Awesome.
Well, awesome. Thank you guys so much for joining me and Perenich.
Thanks for coming to Stonk Tonk. Thanks for having thanks for coming over for Stonk Tonk.
Chink chink.
Appreciate it. Cheers.